Well, good afternoon, my trading and investing friends. Today is Friday, January 6th, and here in the East Coast, it's about 4:30 p.m. But I welcome all of my viewers, whatever part of this earth you exist on, whatever time you're watching this. I want to welcome you to the Stu Thomas Trades Show. Today, I want to bring a brief video in discussion of our U.S. 10-year Treasury yields and the 2-year Treasury yields, what they indicate for the future of Fed rate hikes or quantitative easing, whichever way the Fed happens to be looking to go. And we're going to I'm going to try to point out some things that the Treasury is telling us, which opposes the language, I would say, and articulation of the most recent FOMC press conference. Meeting notes indicated that JPOW and company were dead set on continuing these rate increases. So the language was pretty strong, but is that the case? It seems to be that the U.S. 10-year Treasury yields and U.S. 2-year Treasury yields is telling us something else. So let's just jump in and take a look right now. I've got the 10-year chart pulled up here. And of course, the first thing you see is this pretty glaringly obvious pink elliptical curve line. Don't mind that too much. I was just playing around. I happened to be looking at this chart from a longer term view and saw what looked to be a pattern here. Might as well talk about it since it's up, but I won't spend too much time because I don't know how significant this is. But here this curve has acted as resistance several times throughout history, beginning in the 80s. And then, of course, we had our 2000 and 2008 housing crisis. And here, current day, it looks like we have broken through that resistance, long-time resistance, if it is resistance. I don't know that. And that's why I don't want to spend too much time. But I do find it interesting to find these type of patterns on the charts and then just observe them to see how they actually play out. Another thing I find interesting, if I zoom in here on the daily, you can see that this pink line is intersecting with this orange line, which definitely is, zooming back out to the weekly, a level that has come all the way throughout history from way back. Started this in 1913, 14, 15. I don't know if you guys can see here. It acted as support, then resistance, resistance again, then support over here. Oh, fast forwarding way up to 2002, 2003, support. Then we had this whole 2008, 2009 housing collapse. It was acting as resistance. And here, current day, we're up above that orange level of what appears to be now support. All right, let me get rid of these again. Okay. Sorry about this, guys. And zooming back into the daily, it looks like those two lines are converging, a good area of confluence, possibly, if that pink line even means anything. I know the orange line does. This is definitely significant. All right, so we need to pay attention to that because it is now acting as support. In fact, you can see that we have already used it as support once right here a few weeks ago, months ago, and now we are coming back down again. Are we going to retest that, possibly break through and continue our descent on the 10-year Treasury? One only time will tell. All right, but that is my current persuasion. Now, before I waste too much time rambling on about nothing in particular, let me just pop up the Fed funds rate on here because there is a point I wanted to make. I'm going to say new price scale. And since we are already zoomed in, you can see that there is definitely divergence here. So this is currently where we exist with the Fed funds, and you can see 10-year Treasury way down here. So the two have intersected, crossed. 10-year Treasury is headed down, Fed funds headed up. All right, what does that mean for us? All right, let me get rid of all that real quick, and we're going to zoom back out here. What did I just delete? Oh, the Fed funds. Yeah, put that back. All right, zoom out on our weekly, and I want to take a look at something that has been 100% accurate in the past. Okay, it's not going to zoom out anymore on me. What's going on here, guys? I just want to get this, there we go, to a level that makes sense. All right, we'll leave it like that. All right, so no, now I got to play with it again. So it moved over. Sometimes these charts are very hard to control. Okay, right there. So anytime in the past that the Fed fund rate has exceeded the 10-year Treasury yields, it has always, 100% of the time, guys, 100% of the time, has indicated that the Fed is about to pivot. What do I mean by pivot? I mean by pivot, the Fed is about to surprise us. That could come in my mind, I would call a pivot a 25 basis point hike versus a 50, which I believe the market has already priced in. All right, the market is pricing in another 50 basis point hike. What happens if JPOW and company only does a 25 basis point hike versus 50, or even more than that? Would they pause in February? We'll find out in February, but that is when the next rate hike decision comes. And the market, the Fed has always pivoted in the past whenever these Fed funds exceed the 10-year Treasury yields. All right, so over here is one case. I'm going to put a bunch of arrows up here so you can see. Here's where the Fed funds have exceeded the Treasury, 10-year Treasury again. Here, over here. Now this is something I want you guys to pay attention to, this area right here. Take a look at this long 12-month pause. We'll come back to that in a bit. Over here, Fed funds exceed the 10-year Treasury again. And in every instance here, in just in this view, we have 1, 2, 3, 4, 5 instances where the Fed has pivoted when the 10-year has, or when the Fed funds have exceeded the 10-year Treasury yields. All right. That being said, let's get back to this pause here. This was a 12-month pause, and this happened during the housing crisis. All right, so I want to bring up that chart again. I keep in all of these videos keep alluding to that chart because I think it's so important, so significant. And I want to show you, let's review once again what happened. First of all, I got to go to my profile. I have to open this in a new window, otherwise TradingView viewers, you get kicked out of this video. I don't want that to happen. And I'm going to scroll down. I'm not even going to bring up the chart in full view. I'm just going to bring it up in, I'm just going to click on it here. It's kind of going to be a half view, but I just want to explain some things. I think I can still write on the chart with another tool that I have. So I want you to notice a few things here. First of all, Dow Jones Industrial Average in blue, Fed rates I have in orange, and the housing market is indicated here. It's either green above this weakening demand zone or it's red below. All right, in 2008 and 2009, just before we really called it a housing market crash, in 2006, we we broke below the threshold of what I call this weakening demand zone. And this was in May of 2006. You can see I have it here in this little red circle. So I want you to observe two things. We're going to get over to the Dow Jones Industrial Average, which is in this case representing the U.S. stock markets, and look at what the Fed did. First of all, let's talk about the Fed. When we broke below that weakening demand zone, it was a full 2 months before the Fed finally paused rates. When they did, it was a full 12 months. The question I want to pose to you is, will history repeat again in the future? We know history often does repeat, not always. There's the anomalous behavior. 2020 is a perfect example. But in this case, this seems like a probability that we could see this type of behavior from the Fed again. I always say that the Fed is reactive. And what do I mean by that? They react to what the market wants versus what they are seeing. First and foremost, I would expect in the data, because I'm seeing it, so I know they are seeing it. I'm talking about all the deflationary data. I'm talking about energy prices coming down, gas, oil. I'm talking about used car sales. I'm talking about housing starts in the housing market. I mean, we could go on and on. Even food prices are starting to come down now. And of course, this is a big indicator, in my opinion, the most important. It's the housing market prices. And even rent has, long time ago started coming down. Housing starts, et cetera, et cetera. We could go on and on. All the deflationary data is there. I'm sure the Fed is viewing it. I can't be ahead of the Fed. I know that. Not that smart. But so let's get back to the Dow Jones Industrial Average. All right, so here's where we crossed that vertical line there, which on the RSI indicated we were experiencing a housing crash. Now, this happened first back in 2006 in the Detroit metro area. What happened to cause that housing crash to begin? It was first a recession, of course. Well, there was weakening demand for used and new cars, which has already happened in our market as well. New cars and used cars, this is another deflationary data point, have come down in price. In this case, because the big three were not getting the demand that they expected, they had to lay off labor, all right, workers. And so workers were the first to go. And of course, if you don't have work, you can't pay for your mortgage. And so we noticed this housing weakness first in the Detroit metro area. Fast forward to today, we have crossed below this threshold a few months ago. That was in September of last year. And we recognize weakness here in city markets, beginning with Phoenix and Las Vegas, Austin. I suppose you could put San Diego up there. And so we have come way below. What is the Fed doing? It's still raising rates. What was the Fed doing back here? It was still raising rates. Full 2 months after, before it finally pivoted and fell or paused. And again, this is September-October timeframe, so it would be a full 2, 3, almost 4 by the time February comes around, before the Fed actually does, if they do, we don't know that yet. I'm expecting a surprise sometime this year. It may not be February, it could be March, could be April, but if history repeats, at some point the Fed's going to say, whoa, back up the horses here. We have to do something because inflation is hitting us hard. We're already in a recession. And they pause or they adjust and give back, lower those interest rates, and make, try to supply liquidity to the market again. Anyways, while this was happening, look at the Dow here. It didn't top for a full, I think this was, I don't have this chart pulled up here. I think this was a full year after we crossed this threshold before the Dow actually topped. If that's the case again, we don't top until the end of this year, end of 2023, before our U.S. markets top if history repeats. All right, market's still going up, and that's where my case for a blow-off top comes in play. Our recent highs in November of 2021 is where a lot of people say we topped. I don't think we topped yet before we get to our bear market. This is just a little bit of a pullback. We will probably go into recession, if not more than that, soon. Especially the way that the Fed is responding. I understand they're trying to make the market feel good. But it's all an illusion at this point. It's just a reaction to help investors feel more comfortable. It's not really accomplishing anything significant yet, but if they keep increasing interest rates, it will accomplish something significantly negative, in my opinion. So the market still has a full year before it could top, guys, and that's just the situation we are in. I hope I made myself clear with that, and in terms of you guys pull this chart up, make it your own. I share all these charts, and you can do that by clicking the share button down here and then say make it mine, and then add it to your list here. This is my most significant chart because I do believe that history is going to repeat here, and we are going to see a Fed pivot soon, especially if the housing market is any indication of what's going to happen. And I do believe that the stock market will react the same way. It will continue up as it did in 2006. It was not until 2007, October of 2007, before it finally topped. All right, enough said on that. Now, TradingView people, I am probably going to lose you unless I finish this up quickly. I just wanted to bring that to your attention. All right, so the U.S. 10-year is telling us, no, the Fed's going to pivot soon. What is the 2-year telling us? Let's jump over to that chart. And in this case, I have a descending trend line. You can see that indicated here. That is significant, guys. That's more significant. I know that is important. So jumping over to current day situation, you can see we broke above that. Now, what do I always talk about when we break these significant levels of resistance or support? We like to come back and test those at some time in the future, right? Before we kiss those trend lines. I call it kissing mama goodbye. All right. So again, I think, and it's not necessarily that interest rates will take off again in the future, but I do think we come back down and test that. And that's significant, guys, because if we do come back down, we have a ways to go, don't we? All right. So 18 minutes. I've got 2 minutes left. Let me finish this up by the 2-year basically is a shorter term and a more the Fed follows the 2-year. So every time we have these same situation, when the 2-year when the Fed rates are above the 2-year, you know a pivot is coming very soon. All right, and if I zoom in to our current day situation, maybe I have to bring it up on the daily. Let me do that very quickly. Bring it down here. Let's get my stuff out of the way. All right, so you can see the Fed rates are up here. 2-year Treasury is saying, nope, that's not where we should be. We should be down here. And it's possible, look how long this line has gone across. It's possible that the Fed pauses soon. The 2-year is always ahead of the Fed, and we've already started, by the looks of it, we've already started that pause. Here's the blue line here that indicates that. All right, guys, so that's what I see in the future. And if we do get that even 25 basis points instead of the 50 or a pause, the market is going to take that as with a bullish reaction, and we will get that blow off top, exceeding the November 2021 highs, even going higher before we hit our descent into a new secular bear market. That's my take on it. Hopefully that's helpful. If that has helped you, please give me a like, a comment, or a subscribe, and I'll see you in the next video, y'all. Peace.